Hello again, everybody. Welcome back to Hot Desk, your quick tips and tricks on navigating the Real Desk platform. I'm Mark, your chief desk jockey. And today's topic is probably long overdue for a video. It's one of the ones where we get the most questions, and that's withholdings. Creating a deduction to pay out a third party. Lots of use cases for this: garnishments, commission advance loans, even tax withholdings, where you might want to hold back the GST or HST that a realtor owes and then pay them out separately at the end of each quarter to make their remittances a little bit easier. All of that is possible through the third-party withholdings function in RealDesk. So let's jump right into it and I'll show you exactly how it works. Step one is to create the withholding deduction. To do that, we're going to go into accounting, then deduction manager, choose add deduction, and then choose the realtor. For those of you who have used the deduction manager for other types of deductions know that there are two main types. There is what's called a flat deduction, which would be just like a 10% split or a $400 deal fee. There's also tiered deductions, which we covered in a previous Hot Desk video, which allows you to introduce different levels or tiers as the realtor completes more deals. That might be something like a $500 deal fee for the first 5 deals, then $400 for the next 5 deals, $300 after that, or something like a 20% commission split that then drops to 15% once they reach a certain commissions earned. Generally speaking, a withholding deduction wouldn't have tiers, but there is a way to use the tier system if you want to have a maximum amount, which might be useful for something like a garnishment. You might have a total of, say, $5,000 that you need to withhold, but you don't want to do that off of just one deal. You want to combine that over multiple deals, and that's another feature that we'll get into later. So we'll use the tier system for this to simulate a $5,000 garnishment, and then we'll actually withhold that money over a couple of deals. So we aren't holding back the agent's whole commission. So how do we do this? We'll choose tiered deduction. We will add a new deduction type called garnishment, and then we will do it based on percentage of realtor commission, and we'll do it based on commissions earned as the type. We'll start the deduction today. We'll end it, doesn't really matter, but we'll end it at the end of the year. And then we'll add a tier. And we'll just say, somewhat arbitrarily, we're going to hold back 50% of commission. The actual percentage doesn't really matter because we have the ability to adjust this at the time of the payout. And you'll see me do this a little bit later. But let's say 50% up to a maximum of, since we want to do a $5,000 total holdback for this garnishment, and let's do an upper threshold of $10,000. And you'll see that that means that the maximum actual deduction that could happen under this is $5,000, which is what we want. We'll click add. And then if we don't add another tier, and this is sort of the beauty of this deduction will just go away. So once we've deducted $5,000 total, we won't see this pop up anymore when the agent has further payouts, because historically that's been a bit of an issue when you create flat deductions. They continue, if you don't edit the end date, they'll continue to sort of show up forever. So another way to get around that versus editing the end date would be to set up this tier system so that once we hit $5,000, this will stop. There's a couple little last bits at the end. And the first part is to click the third-party deduction section. Now you have to specify a payee name. Let's specify CRA in this case, unless you choose pay to current realtor. And that is what you would use if you were going to do a GST withholding. The other thing you'll notice, and this is something that we've added fairly recently, is that any withholding is automatically marked as tax exempt. And finally, you'll also notice that for every other type of deduction, we get to choose an income account in QuickBooks where we would sync that deduction. And typically that could be something like deal fee income, split fee income, something that designates it as brokerage profit. In this case, the withholding automatically goes to a liability account that is set up as part of the RealDesk to QuickBooks account mapping called third-party withholding liability. It's a liability account, not an income account, and that's because until you pay this out, this is a liability and it's certainly not brokerage income. So that's the first step. We'll hit save deduction. And then the next step is to pay out deals. And I've created two fairly similar deals for the same agent so that we can spread this deduction out, $5,000. So let's take the first deal. If I look at this deal, there's $14,000 plus tax and commission. So when I hit create payments for this deal and I go into the buying realtor section, it's going to try to deduct the full $5,000 because it's 50% up to a maximum. So let's say instead that I don't want to do this. Like I mentioned before, I want to spread this out over two deals, so that's perfectly fine. I can just change this to $2,500. The amount payable to the realtor will adjust to reflect that. I'll hit create payments and you'll see that there's now a withholding of $2,500 as part of this deal. This $2,500 is still sitting in the commission trust account because we haven't paid it out yet. That will be in the next step. But for purposes of being able to close the deal, we need to be able to mark this ledger down as $0, which is correct in the context of the deal. So that's why it says WTH here instead of an actual payment, because we haven't set anything up yet. So let's go do the same thing for the next deal, and then we'll have our full $5,000. We're in the second deal, and you can see here that the gross commission is $19,000. Again, it's going to be 50% up to a maximum of $5,000, but we've already withheld $2,500. So when I hit create payments for this deal and I go into the realtor section, we should expect to see it suggesting a $2,500 deduction, which is exactly what it's done. If I click here on the information section, you can actually see how many deals we've done to date, which is 1 so far, and then we've got $2,500 left, so it explains how this whole thing works. So we're going to deduct the remaining $2,500 off of this deal, and then this deduction won't show up again because we've now hit the maximum amount. Hit create payments, the exact same thing happens with this $2,500 showing up here with this WTH label to indicate that it hasn't been paid out yet. And then the next and final step will be creating the withholding payment to the third party, and that's what we'll do next. I mentioned earlier that one of the nice things about the withholding payments feature in RealDesk is the ability to combine multiple withholdings off of different deals, as we've done here, into one payment and then pay out the third party. So I'm going to click into accounting and then go to withholding payments. I'm going to select the account from which the money will come, so commission trust. Typically, if you have a commission trust, all of your withholdings will be in the commission trust account. You can see that we've got two different withholdings there. They're both going to the same target, so third party. And so we have the ability in this case to combine them. And so I'll simply click here to select all and hit create withholding payments. It will show you the total amount and it will ask you about the payment method. If you're paying from a check out of your commission trust account, it will automatically suggest the next check number in your sequence, as it would if you were in send and receive payments. And then the check payable field will simply be the name of the third party that you identified in Deduction Manager at the beginning. Once you're happy with this, you can simply click create withholding payments. And at that point, you will have a check in your pending checks area. You'll also notice that when you go into send and receive payments for one of these deals, that instead of saying just WTH, it will now give you the check number. And so you'll be able to link that back to the payment that you've now created. I should also mention here we have some enhancements coming shortly where you will be able to create a payment profile for a third party like CRA or like a commission loan company, provide the bank information the same way that you would now for an agent or a lawyer or another brokerage, and then create an EFT with a withholding payment. Currently, we don't support that for third parties, so you can either do a paper check through the system or an EFT outside the system, but it's coming very shortly to do an EFT within the system as well. Then the last piece of this is how this looks in QuickBooks. So I mentioned earlier about the third-party withholding liability account in your chart of accounts in QuickBooks. And this is important because if for whatever reason you don't pay these withholdings out right away, which would be the case if you were doing something like a quarterly tax withholding, then that money will remain in the trust account and for liability purposes in QuickBooks, it'll get booked against this third-party liability. So when you're doing a month-end reconciliation, you have to take this third-party liability into account when you're looking at, in this case, your commission trust balance. In this case, we don't have any other money in the commission trust, so it's fairly easy. We can see that the $5,000 cash balance in the commission trust account matches the third-party liability. But if we had other funds mixed in there that might be the commission trust liability account, you can see how you would essentially need to add up those two balances, and that should match the money that you have in your commission trust account. Once you've paid off the withholding, it gets much simpler. Both the money that was in the commission trust bank account and the third-party liability go away, and you're left, in this case, with just commission income and commission expense. In terms of how this looks in the chart of accounts, if we look at this third-party liability account, you can see how these two deductions that get taken off of each deal increase the liability account balance, and then that is correspondingly decreased when we do the withholding payment. The withholding payment is done in the form of a bill, which we can see here. And a new feature that we've just released in the system is that if you have multiple deductions off of different deals, they will be treated separately in the bill by separate lines, as you can see, and the deal number will be in there as well. So this just provides a little bit more traceability to be able to see which deductions from which deal specifically made up this, in this case, $5,000 payment, that this actually came from two different deals. That's the process of creating withholding deductions and then creating a withholding payment and paying that as well. Hope this helps. Let us know if you have any questions. Don't forget to like and subscribe on YouTube. It really does help us. And thanks, as always, for being part of the Real Desk community.